after it opened. We hit those highs right away. Pretty much has just been down since then. So it's always tough when you find yourself in that situation. Believe me, I've had my struggles with things like that in the past here. Now the question is, what do you do? What do you look for here? You can see that our volume profile, our point of control is right near where our current prices are now. So that tells us that the area of heaviest trading is at this very low point on the chart here. So kind of a situation where you could look at it one way and say that all this heavy trading has come in. We don't really have much farther to go. Perhaps the bottom is in this name. If you are more interested in the upside, which I think many of us probably would be, because there's not a whole lot of trades you can make when something is in the single digits like this. There's only so much farther you could go down. If you're more interested in the upside, you can see we had a small topping price right there. It matches up with our 63-day EMA in orange, right around 283. So if we were to break above that level, the next point I would probably have my eye on as a trader would be these highs that we hit. Right around here, it matches up with our +1 standard deviation channel near 410. To the downside, though, if things do continue to deteriorate, if we do take out those old lows near 234, well, you could look at our old downward trend line. That old resistance could become new support. That's pretty close to that same area near 230 or so. Then we've got our yearly linear regression line. Our line of best fit comes in at 125. That would be a pretty rough move on top of an already rough year. So hopefully it won't come to that for the bulls, but you never know.
Yeah, and as I know too well myself, things could always go lower. When you think they can't, they're always capable until we hit zero, obviously. But appreciate the breakdown on both of those retailers ahead of their reports. And now, Alex, when trading this name, given its relatively low share price, say you were looking on a more optimistic approach, you were going with what Rick said, you don't believe things could go lower and you're more bullish, just for example purposes.
It's not that I don't think Rick said they can't go lower, it's just you
No, you're
can't
right.
really
I take that back.
you can't really express that in a trade at this point. I mean, you could look at buying a put, I guess, but you can make $2 and you theoretically can lose unlimited in terms of the upside. So there's just not a lot of juice left to be squeezed on the bearish side. So looking at a bullish strategy, and one thing I thought that was somewhat optimistic was this stock has basically spent its entire life as a publicly traded company going down. Well, it's going sideways now, as Rick talked about. So how do you stop going down? Well, first you go sideways, and then maybe you go up. So you think the bottoming, which may take a long time, is starting to happen. Perhaps you become an investor in this stock through stock shares, or perhaps you go out and you buy a call to reflect that as well in more of a risk-defined way. And so that's what I looked at here. I went up to September because the options really aren't that expensive. I looked at buying the $3 call for 50 cents. So your break even is going to be $3.50, which is a big percentage move higher in this stock share, but you got to go out to September for this. So you have a little bit of a leverage factor there and time that you're paying for. Unlimited profitability. Looking with this one for 50 cents, theoretically can make unlimited money. If it was to turn around and perhaps make a run to the upside, this would be uncapped. So I think for many, this is probably a name that unless you have a strong conviction one way or another, probably not even one you're watching, but I did want to talk about, how do you navigate these lower priced stocks? I think the first thing you should consider, do I want to be a stock shareholder in a name like this? If not, you can start looking at things like buying a call or some of the other strategies that we talk about on a daily basis.
Right, and of course, a more capital efficient way than just outright buying shares, which is, of course, another strategy here for Petco, which, woof, unfortunately, the greatest sticker, not seeing such great activity as of late, but we'll be watching their earnings very closely. But coming up next, it's time to talk FOMO. We are looking at Apple, which is making a modest move to the upside today, but many street analysts are saying that perhaps some of the selling could be overdone at this point. We'll discuss that more coming up next.
My dad was a hard worker. He used to do side jobs installing windows, charging something like $100 a window when other guys were charging $400 to $500. He just didn't want to do that. He was proud of the price he was charging. My dad instilled in me, always put the people before the money. Be proud of offering a good product at a fair price. I think he'd be extremely proud of me. Yeah.
Binge watch the market with the Schwab Network. Tune in 24 hours a day, 7 days a week at schwabnetwork.com and on all your favorite streaming services. Schwab Network, Available anytime, anywhere, on any device for free. Schwab Network.
Spotlight the biggest market trends on Trading 360. 11 a.m. Eastern, only on Schwab Network.
Kickstart your morning with a full dose of commodities, technical analysis, economic data, and live reaction in global markets. Available anytime, anywhere, on any device for free. And available on all of your favorite streaming services. Futures with Ben Lichtenstein every weekday, 8 a.m. Eastern on the Schwab Network.
Wrap up the trading day with me, Oliver Rennick, for the biggest earnings coverage, 3 p.m. Eastern. It's Market on Close. No place better than the Schwab Network.
Download the Schwab Network app and join in on the latest market trends. Anytime, anywhere, on any device for free. Schwab Network.
Welcome back to Next Gen Investing. It's time for FOMO. Today we discuss Apple, the once mighty Apple, one of the main Magnificent Seven names. It's kind of fallen out of favor for investors in 2024, Jenny Horn, but the last few sessions it's joined the party a little bit, particularly when we saw it sort of lead on the weekdays. But now it's still an underperformer today, but it's at least moving higher on the same day that the market is moving higher. This hasn't been the case all day. It was actually week early, and it just continues to have sort of this uniquely inverse correlation to the S&P 500 for a name so big. This is a rare occurrence.
I know, it feels very unfamiliar for a name like Apple, which is always the green spot in an overall sea of red. I mean, it's been the complete inverse of that. We were talking about its correlation at this point to the S&P 500, which it's basically trading completely inverse to the overall index, which is just fascinating in itself. So despite the hit that Apple has, of course, taken this year, the street says it's time to buy shares. Overall, analysts getting some positive commentary here. Apple shares have dropped about 10% this year, lagging, of course, the other members of this so-called Magnificent Seven. It's a stark decline from the almost 50% increase we saw in share price in 2023. But there's been several reasons, at least, for some of this pressure. One being weak iPhone sales in China, regulatory concerns, a lack of clarity on some of their plans for generative AI. But despite these concerns, Street still remains fairly optimistic. 43 analysts cover this name, 25 are buy, 13 holds, and 5 bears, which is actually the most bearish skew I've seen on Apple in quite some time. This is notoriously one of the highest buy rating stocks we talk about. That's not really the case anymore, but average price target is $200 a share. That does imply about a 16% increase from where we closed on Monday. Evercore ISI said that they believe that overall the selling pressure is overdone and that there's some distinct drivers that could unlock upside from here. They think that Apple will incorporate generative AI into their iOS functionalities, which would then be obviously hugely beneficial because AI everything right now is the trade to be in. But overall, their hardware actually has B of A optimistic as well. This analyst said Apple's ability to retain market share in smartphones, even if international sales struggle to intensify, they think their strategy of lowering the price of older phones while launching these new versions keeps customers coming in. It keeps existing customers upgrading to the next best thing. So they basically see nothing but positivity for Apple. And they do have this conference that's occurring in a few months where so many of these analysts believe that they'll unveil more of their AI strategy, but they've actually been relatively quiet on the AI front, which is interesting for a name that's usually at like the forefront of tech.
Yeah, it's been disappointing for Apple investors, and there's been periods of time throughout the last 10, 15 years that have been similar. It's recovered from them, but we had an entire year last year where Apple didn't have revenue growth. And so you're starting to look at this company in a different way, not in a negative way per se, but less in a growth way, more in a, it's a share friend, buys back shares. It is in somewhat of a value camp at times, but that's not really where the market has been putting capital to work over the last 3 months. The market's been putting capital to work in places like NVIDIA, in places like AMD, in places like SMCI, and some international markets, places where there's this desire for growth and appreciation on capital, not income-like performance. And so you look at Apple, and a time that's been very, very strong for the market, it's actually much closer to its lows going back to the end of October, November, beginning of November, than it is to where it got kind of towards year end, near $200 a share. So I would say near term, despite all the optimism that tends to follow this name from an analyst perspective, the fact that this is one of the most widely held names of all investment, the near-term feeling of missing out is to the downside, I think, Jenny.
I agree, and I will say there was this Barclays note where the analyst downgraded shares to sell and had I think like $160 price target, which at the time was significant. And I was the one saying we all focus on the negative in Apple, like we never pay attention to the positive anymore. But that was the beginning of this year, and that analyst was completely right, because all of these various headwinds have somewhat caught up to Apple. And I do think, at least with some of the pressure we've seen, there's been some reasoning. I mean, they've had serious mishaps, like their watch with the patent infringements. That was a problem. China sales are a problem.
All the stuff going on in Europe.
Right, and they did even say, we did get some news that Apple did say they'll allow these developers to distribute apps in the EU directly from their websites or these alternative marketplaces rather than just through their app store. So that was, I think, to appease these EU regulators. But despite this new distribution method, developers will still need to comply with Apple's very strict app development rule, which basically says that they offer this web distribution that must meet the requirements to protect their platform. So basically, it's like they're giving them somewhat of leeway.
But is you give an inch, take a mile kind of a situation? Is this the beginning of the end of the Apple App Store cabal?
I know, I wonder that, because to me it feels like they're giving them the slightest bit of hope, but it's not necessarily, I'm sure, what exactly regulators would have wanted in Europe, but nonetheless, it's at least progress. But I feel like we talk about all these various things like the watch or like the Vision Pro, but what matters to this company is the iPhone. I mean, this is 50% of their revenue is the iPhone. So weakness in China, I think, is more of the near-term concern than any of this debacle happening with their app store.
Yeah, and the fact that they're just not growing. It's a collection of all of these things that we're talking about. The revenue's just not there in terms of growth, and in the end, when there's companies that are growing at huge clips like NVIDIA. And I think now, here's another thing, and we're going to get to the trade, but this is another thing that I think could be construed as potentially bearish. The market's found a way to still do well without Apple. And there's probably a big subset of investors who probably didn't know that that was possible. But the market is fully negatively, inversely correlated to Apple right now, as Apple's been weaker. So is Apple leading the market lower, or is the market leaving Apple behind, I think is the question. And I think there's reason to think that the latter could be the case. So I looked at a strategy that fades this recent jump that we've seen in the stock. Basically seeing this near-term, kind of bounce in Apple is simply that, just a bounce and an opportunity to potentially get bearish into the recent strength, selling into its recent strength using a call vertical. So it is risk-defined in the event that the stock does continue to rally, but it goes up sort of towards a near-term range where we had spent a lot of time around 180 and uses that former support as a potential resistance point. Going on to the April 19th monthly cycle, selling the 180, 185 call vertical, Jenny. Looking for at least $1. You'd want more of a credit if you could get it, but if $1 is available, you would take $1. The more, the better. It improves the risk-reward ratio, and of course, raises that break even and reduces the risk on these credit spreads. But that would be $400 in risk, as listed there with the $1 credit to make 100, 181 the break even. So risk defined with that risk definition, for many that would allow them to have staying power in the event that Apple does test this mark, knowing that you can't lose more than whatever that risk definition is, in this case $400. But it also fades the move a little bit, does so for a credit, so you're able to collect that $100, and as long as it stays below 180 going out to April, that would be your max profit.
Yeah, and I think this is an interesting day that we're looking at the FOMO feeling of Apple to the downside. I believe this might be one of our first times looking at an example trade in Apple bearish, just because it's so remarkable in the sense that when markets go up, Apple goes up. So yeah, I think it has been amazing to see, like you said, markets going up without Apple obviously going up, as we're down about 10% since the start of this year. But we will leave it there for FOMO today. Now coming up next, time to talk all things CPI and the 10-year note auction. CPI hotter than expected, but markets overall shaking this off today as we're still up in 3 of the 4 major indices.
Young lady who was mid-30s, a couple of kids, recently went through a divorce. She had a lot of questions when she came in. I watched my mother go through being a single mom. At the end of the day, my mom raised 3 children, including myself. And so once the client knew that she was heard, we were able to help her move forward. Your client won't care how much you know until they know how much you care.
Every morning, our analysis is your blueprint for the day. Bonds.
Anywhere on any device for free. Binge watch the market with the Schwab Network.
Power your portfolio with the Schwab Network. Schwab Network, available anytime, anywhere, on any device for free. Schwab Network.
Welcome back to Next Gen Investing. It's time to discuss the economic data that has shaped a lot of the overall price activity, if you could call it that, though, because we're shaking off hotter than expected CPI pretty well, actually, on the session. But here to discuss that more, as well as the 10-year note auction, I'd like to welcome in Kevin Green, Senior Markets Correspondent for the network. So, Kevin, I looked at this report first when it came out this morning. Shelter was basically my big takeaway because I know too well how that has affected me as a consumer. But walk us through this report and really your takeaways here.
Yeah, Jenny, and shelter continues to come in fairly hot if you're looking at the expectation of really trying to see that coming in at 0.2%. That did come in at 0.4%, which was lower than what we saw last month, but once again, a very big component when you're looking at the overall CPI number, as it does constitute around 30 to 35% of the overall index here. We also saw an increase when it came to energy prices as a whole. We know gasoline prices have moved to the upside, but also when you're looking at the utilities piped, we continue to see some pressure there, some residuals from the Arctic blast that we saw in January here. We did see the year-over-year number for headline CPI coming in at 3.2%. That was actually higher than what we saw for last month, 3.1% if you're looking at the annualized numbers. And we continue to see these month-over-month prints coming in hotter than what is expected. And if you're looking at the 3-year annualized rate, we are now well above what the Fed's target is, or what they would like to see for inflation right now. The core CPI also did increase by 0.4% on a month-over-month basis, coming in at 3.8% annualized, but that did actually decrease from the prior print in January. So overall, if you're looking at just the two baskets, energy and shelter, that actually did account for around 60% of the total increase. And unfortunately, Jenny, energy prices continue to rise even in the month of March, and that could also be another headwind that we see here in the next print.
Hey, Kevin, I know we got some stuff on this auction as well, but before we do, I want to get your thoughts on the fact that last year around this time, in February of 2023, Jerome Powell basically pointed to a metric that's become known as the super core, which is essentially core services, less housing. So this is a piece that has a big influence on the PCE. Well, our colleague Liz Ann Saunders tweeted out, on a 3-month annualized basis, this super core services, less housing, or X housing, increased by 6.9% in February. So if we're led to believe that this is what the Fed looks at, this seems like a lot more than just hot. This seems like this is bad news for those looking for Fed cuts.
Yeah, it's definitely a problem, Alex. And actually, when you're looking at that super core number over the last 3 months, the month-over-month prints continue to come in a lot hotter than the street's expectations. And you're right, that could actually have a direct impact when you're looking at the PCE number, now, which obviously has a little bit different mix. It really does focus on the retail prices, but I'm right there with you. Not only are we seeing the pressure when it comes to energy, but you're also seeing it in some other pockets of the marketplace. Now, I think the biggest question right now is going to be what's happening with food. Are we seeing the food prices actually stabilize? Because food actually did come in flat on a month-over-month basis. Food away from home also came in favorable for that particular number. And so there's pockets of strength when you're looking at inflation, and there's also pockets of weaknesses that are great. But you are right that the super core number, which I find very interesting, it takes out everything that really impacts us on a day-to-day basis. It is getting a little bit hotter as well. And this reflationary trade, unfortunately, does seem like it may be coming to light here as the comps in March and April are going to be a lot lower, meaning that we could see these year-over-year prints actually continue to rise higher if we're at the same trajectory that we are right now.
So, Kevin, given that we've gotten this inflation read, then what are we seeing from overall treasuries? Of course, we want to look at that 10-year note auction.
Yeah, so we saw treasuries actually, well, we saw a wild ride for treasuries, but we saw treasury yields rising throughout the equity session so far. And we had the 10-year auction. We offered around $39 billion for that auction. And the high yield came in at 4.166%. So it was around 0.9 basis points higher than the secondary offering, or secondary market, which is not a really good sign to say the least. The bid to cover did come in at 2.51%. Or 2.51, which really represents the amount of dollars for the offering total. So you want to continue to see that number move to the upside. The previous print was at 2.56, and the dealer takedown came in at 17%, a lot higher than what we saw in the previous month at around 13%. And one key area of weakness for this particular auction was foreign buyers actually came in very low to say the least, not even on a seasonal basis. So that was another reason for some of this weakness. We did see yields go higher, but the equity markets have shrugged it off and have moved around 10 points higher if you're looking at the S&P 500 since the auction results here.
Yeah, and like you said, treasuries have had quite a day here in real time, so we'll be keeping that on our radar very closely, but appreciate the breakdown as always. Great look at all that economic data that we've seen impact markets somewhat today. Kevin Green, senior markets correspondent for the network. Now coming up next, it's time to look at On Holdings, the stock that is all over my social media, all over my targeted ads, but unfortunately today seeing a pretty substantial move to the downside following their earnings. We'll discuss that with George Tillis coming up next.
I was born on the south side of Chicago. It's been a long road, but now I'm working for Schwab. I love to help people understand the world through their lens and invest accordingly. You can call us Christmas Eve at 4 o'clock in the morning. We're gonna always make sure that you have all of the financial tools and support to secure your financial future. That means a lot for my community and for every community.
Download the Schwab Network app and join in on the latest market trends. Anytime, anywhere, on any device for free. Schwab Network.
Trading the trending names every day. It's Fast Market. Ready for you, ready to go. I'm Kevin Hinks. Catch me on Fast Market, weekdays at noon on the Schwab Network.
Cut the cord on the way you get market news. It's Market on Close. Join me, Oliver Rennick, for the biggest earnings coverage and insights from the smartest minds on Wall Street. Monday through Friday, 3 p.m. Eastern, available anytime, anywhere, on any device for free. Only on the Schwab Network.
No politics, no noise. From bell to bell and beyond. Available anytime, anywhere, on any device for free. Schwab Network.
Missed out on today's market headlines? Get caught up and catch the wrap at schwabnetwork.com. Available anytime, anywhere, on any device for free.
Welcome back to Next Gen Investing. It's time to look at a story today, that being Nike. Renita, senior markets correspondent here for the network. So we're diving into all of the various analyst opinions ahead of their earnings next week. Walk us through what you're seeing.
Well, shares have turned lower on the day, and it's because of two mixed situations happening. Now, while some analysts decided to cut their price target, they're still maintaining these ratings that are close to or equivalent to outperform. But then this is causing everyone to look at the earnings expectations, right? That the company set for itself versus what analysts expect. And it is expected to be lower, or revenue and earnings are expected to fall. But let's take a look first at these few analysts who've updated their coverage. Morgan Stanley maintained an overweight rating, cutting the price target by $1 to $124 a share, which is still above where it's trading today significantly. RBC cut its price target to $110 from $120. That's a relatively medium-ish cut, but it's still higher than where it's trading and keeping it at an outperform rating. Guggenheim keeps it at a buy rating and announces a $130 price target, the most bullish of them all, right? But when Nike reports its earnings next week, analysts expect the adjusted earnings number to actually fall around 20% year over year to 70 cents a share from 87 cents a share where it was a year prior. Sales are expected to fall almost 1% to about $12.29 billion. That goes down from about $12.39 billion the year prior. And the company said that it's going to focus its core product innovation, focus more on core product innovation. So we can expect to hear more from that, but it's all a part of the company's plan to cut about $2 billion in costs. Now we know that it also announced a job cut of about 1,600 people. That's around 2% of its workforce. So we can expect to hear more about that and how the company plans to optimize what it has left.
Yeah, and I do say that, Renita, this unfortunately does mark usually the tail end of earnings season, so I always get sad when we're previewing Nike, but given some of their underperformance, I do hope that these analysts are correct and we see some upside in what has been a pretty beaten up retailer, but we will leave it there. Great breakdown, as always, Renita Young, senior markets correspondent. And now to look at another name that is reacting post-earnings, but is in the similar athletic shoe retail space, that is On Holding. So I'd like to welcome in George Tillis, senior markets correspondent. George, a very much negative reaction to what was a surprise loss from this company. Some of their metrics, I will say, looked objectively strong to me, but walk us through what you saw.
Yeah, you're right, Jenny. I mean, if you look at across the board, there was obviously an earnings miss for On, which, again, I'm sure a lot of people are familiar with the brand. I mean, I see the brand, growing, not just from the standpoint of leisure wear and lifestyle wear. That's where I started to see it initially, but I think now you're actually seeing it from a sports performance brand standpoint, starting to pick up where, track and field and marathon runners are starting to use their products. And I think that's generating some good brand recognition for a company which is growing still pretty tremendously. They did grow their top line sales by 34%, but for the quarter, they unfortunately missed by about $6 million to $504 million versus the $510 million that they estimated. Now, the other thing is unfortunately for the company, the earnings per share were estimated to be essentially an 11-cent profit, which would have been essentially a 4 to 5 times increase compared to the 2 cents last year, but for the quarter they reported a 6-cent loss. So, the expectations being, I think, quite high compared to last year going into this with the miss. That's why we're seeing the stock move to the downside. But a lot of times with these one-off quarters, there can be a lot of different reasons. Currency aspects may be a reason in this case, considering it's a Swiss company. The other thing is capital expenditures, marketing expenses. Might have been a little bit higher than expected, and maybe sales volume, which again was the case, was lower than expected based on pricing power. But if you actually go through just quickly through the overview of the transcript from the conference call, they did denote as a company 59.6% gross margins. That was actually higher than last year at around 58%. And nonetheless, irrespective of the quarter loss, they still eked out a 4% profit margin for the last 4 quarters. But here's the kicker. If you look at the performance today, and I think I mentioned this before, and then the adjusted earnings guidance prior to the release of earnings, those are on 82 cents, and now it's 78 cents for 2024. So that effectively puts that forward multiple at around 42 times. But if you compare the percent change in the guidance using that 4-cent adjustment, it's around 4.5%. And then we talk about, and I talk about how there's always somewhere between a 2 to 3% rate of change in price relative to an adjustment in the rate of change of the earnings estimate. So if you do the math, that's about a 14% difference in earnings adjustments and essentially, 4.5% adjustment in earnings, and you actually see about 3 times that movement in the stock price.
So along those lines then, George, I think the reaction is straightforward. They swung to a loss. The revenue growth, is basically cut in half sequentially. There's just not a lot of positive in the numbers that they actually reported for the Swiss-based shoemaker. Roger Federer backed, so big names alongside this company when it comes to sort of the influencer space or celebrity space. But did anything from this change the story? Is this no longer the growth story it was? And I guess you don't know for sure. Is there something here that we're alarmed by, or is this just like a shocking disappointment from a quarter standpoint that resets the stock price and then we reassess?
Yeah. So that's a great question, actually. I suggest in this particular instance, it may be a quarterly adjustment because, you've got, Olympic brand sponsorships that are going to be expensive going forward. You have, prominent influencers that need to be essentially compensated for their marketing of the